I remember some time ago having a conversation with my dad regarding the interest rate scenario in India. And he mentioned that in 80s and 90s, FD rates in India were as high as 10 to 12%. But unfortunately, FD rate in India are on continuous decline mode. And today, an FD with top tier bank in India fetches an interest of just around 6%. And that too, that interest is taxable. So considering the inflation rate in India at 5%, the effective post-tax return from FD is not even able to beat the inflation. And that is a big pain for investors who are looking for investment options with fixed returns. But what if you have an option to fetch not just 8-9% return, but as high as 12% return? Well, on one side, while FD and other fixed instruments options are offering just around 6 to 7% return, an interest of 12% is very exciting, isn't it? Hey everyone, my name is Sahil and this is my Personal Finance Academy. I recently did a video on best options to build an emergency fund and I received multiple requests to review 12% Club. So here I am with an honest review about 12% Club. First thing first, we need to understand what exactly is this 12% Club. So essentially, it is a peer-to-peer lending platform. Now I'm sure majority of you would not be aware about what exactly is this peer-to-peer lending and how exactly does it work. So I have divided this video in 4 parts. First, we will cover what is peer-to-peer lending and how it works. Then, we will look at the risk versus reward while investing in peer-to-peer lending. Then third, we'll try to understand this 12% Club and its offerings. And finally, I'll discuss if it is worth investing in this 12% Club or not. Alright, let's get started. Let us try to understand this peer-to-peer lending model with an example. So on one side, you have a set of people who have excess money that they want to invest and fetch an interest rate. On another side, you have a set of borrowers who need money, be it for investment in business or buying a home, car, etc. And they are willing to pay interest on that borrowed money. Now this model of lending and borrowing dates back to many centuries ago where rich people would lend money to borrowers and fetch very high interest. This interest was as high as 18 to 24% during the old days when banking system was not that prominent and there were only a handful of public banks in India with limited reach. So that was the original peer-to-peer lending system without involving any bank or intermediate in between. Slowly banking system got prominent where banks would take money from lenders and give them a fixed interest and then further lend that money to borrowers at higher interest rates and in between keep their margins. By the way, this is a great business model. The only risk here is payment default. Now, if you directly lend money to someone without involving any bank, then you can certainly fetch higher return, but there is a high risk of default. What if the person doesn't pay back? In that case, you will not only lose out on the interest payment, but would lose the entire principal amount. During the old days, peer-to-peer lending was mainly on trust without any collateral, but there was high risk of default, and that's where banks came into picture to manage the default risk. So you just need to keep money with bank and fetch fixed return from FD or from saving account and not worry about defaults. It's the headache of banks. However, in this process, you end up fetching very low interest rate as bank keeps a good margin in between. And that's where peer-to-peer lending companies have emerged in recent times where you can directly lend money from one person to another. That's why it is called peer-to-peer. These peer-to-peer lending companies act as an intermediate that uses technology to build the economy of scale. So those who want to lend money can create an account as lender and lend money. And those who want to borrow money can register themselves as borrowers. Now these peer-to-peer lending companies offer very high interest than banks. Here it is very important to understand how peer-to-peer lending companies are able to offer much higher interest rates in the range of 10, 12, 15%, whereas banks are offering merely 5-6% interest. So the simple reason is peer-to-peer lending companies lend money to small business vendors who are desperately in need to borrow money. It could be for a very short time period. So let's say a person has a business where it has to pay its creditors in the next 10 days and that person has got a very small time window for payment and desperately in need of money. In that case, that person is also willing to pay much higher interest. That's where the person can come to peer-to-peer lending app and borrow money. Moreover, in majority of cases, people with weak credit profile who don't get loans from bank come to these peer-to-peer lending platform to borrow money. So basically, these peer-to-peer lending apps lend money at much higher interest rates, and hence they are able to offer higher interest rates to lenders. So think this way, if you are fetching 12% interest, then that money has to be lended at higher than 12% interest, then only it will make sense, isn't it? If these peer-to-peer lending companies are offering you 12% interest and then lending that money at 8 to 10% interest rate, then they would be in loss. So they have to lend that money at higher than 12% interest. Basically, the business model of these peer-to-peer lending company is very simple. They charge a platform transaction fee from both lender and borrower, and that's how they make money. So the simple reason why these peer-to-peer companies are offering much higher interest than bank is A, because they are lending that money to person at much higher interest rate who is desperately in need of money. Banks have a very stringent credit process and many people don't even get loan from bank. So these peer-to-peer lending companies come to their rescue. And B, because these peer-to-peer lending companies uses technology to scale their business and take a small margin in between as compared to bank that has much higher margin. So I hope now you understand how these peer-to-peer companies are able to offer such high returns. Here you would be thinking, if these peer-to-peer companies are lending money to people at much higher interest rate, whom even the banks would deny giving loan, then it would be very risky, isn't it? So in the next part, we'll discuss the risk versus reward aspect of peer-to-peer lending business. By the way, now you can also listen to my podcast on Spotify and can even watch my video on Spotify. I have a podcast with name Personal Finance 101 with Sahil Bhadviya. I provided the link below. And if you want to learn every aspect of money management, I have a complete course and you can explore that as well. There's no doubt that peer-to-peer lending is much riskier than bank as they are more exposed to high credit risk. However, these peer-to-peer lending companies claim that they have a very stringent verification and credit underwriting process. But again, this would vary among various peer-to-peer lending companies. Now, how they are mitigating the risk is by giving loan to not just one person but hundreds and thousands of people. So think this way, if you have 1 lakh rupee to lend and if you lend it to just one person, then there is high risk of default. Instead, if you lend 10,000 rupee each to 10 people, then your default risk would reduce. However, it is unlike that 10 people will default altogether. And if you lend 1,000 rupee to 100 people, then your risk would reduce further. That's what these peer-to-peer lending companies do. They distribute the money among multiple borrowers. Here it is very important to note that peer-to-peer lending business is regulated by RBI. So RBI has set a strict guideline on how these peer-to-peer companies can operate. For example, a lender can only lend a maximum of 50 lakh rupees across all peer-to-peer platform and borrowers at any given time. Borrowers can take a maximum loan of up to rupees 10 lakh across all peer-to-peer platform. Although please note that unlike your banks where you have an insurance up to rupees 5 lakh under Deposit Insurance and Credit Guarantee Corporation, peer-to-peer lending platform doesn't have such insurance cover. Second, these peer-to-peer lending companies do not guarantee returns on investment. Please note this, it is very important. They clearly mention that there is no guarantee on return on investment. So if I summarize the risk versus reward, you can certainly fetch very high interest on peer-to-peer lending platform. However, it is riskier than banks. Although unlike your stocks or equity mutual fund, there is no market risk. So your money will not fluctuate on a daily basis. But there is a credit risk that include your default in payments. But again, this risk would vary from company to company. These peer-to-peer companies do have a credit underwriting process and they reduce the risk by distributing money among various borrowers. And it is also regulated by RBI. Now let us try to explore this 12% club. When it comes to peer-to-peer lending platform, 12% club has got a good popularity. As the name suggests, it offers 12% annual interest rate to investors. It's basically a product of BharatPe, which is a new age fintech company. Now this 12% club only acts as an intermediate platform to facilitate borrowing and lending. So 12% club has collaborated with various P2P NBFC partners for providing these services. The investment amounts are placed with RBI regulated peer-to-peer NBFC, Innofin Solution Private Limited, also known as Lend Club, and NDX P2P Private Limited, also known as Liqui Loans. And the borrowing is extended by RBI regulated NBFC, Hindon Mercantile Limited. One of the most interesting feature of 12% club is daily interest credit. So when you invest your money, you don't have to wait for say 1 year to get interest. You'll fetch interest every single day. For example, if you invest 1 lakh rupee, then 12% rate, you will fetch 12,000 as interest. Now you divide it with 365 days, and that means you will fetch 33 rupee a day as an interest. That's a brilliant feature. And another interesting feature is instant withdrawal. So if you need money, then you can request for withdrawal and you will get your money credited within 1 business day. Here, please note that this 12% interest is not guaranteed. They have clearly mentioned in their FAQ section. It means if there are high defaults, then interest rate can fall. So far, the NPAs of 12% club are under control within 5% limit. So it should continue to offer 12% rate. Although I could not find their borrower details and NPA details on their platform. So let me again repeat that 12% club only acts as an intermediate platform to facilitate lending and borrowing. The risk is managed by its NBFC peer-to-peer partners. So you can either choose 12% club or directly invest in peer-to-peer NBFC companies like Liquid Loans or Lend Club. Likewise, there are a lot of other peer-to-peer NBFC companies like Lendbox, Faircent, Paisa Dukaan, etc. I hope you got a clear picture of what exactly is this 12% club and its role. Now in the final part, let us discuss if you should invest in this 12% club or not. First of all, let me address the question, is 12% club an alternative to FD? So the answer is no. Peer-to-peer lending cannot be an alternative to FD because when you invest in FD of top tier bank, you get guaranteed return as the credit risk is very low. So FD is for those who have very low risk taking appetite. However, in peer-to-peer lending, the credit risk is on higher side and hence peer-to-peer lending is for those who have high risk taking appetite. Peer-to-peer lending was approved by RBI in 2017. So it's in a very nascent stage and so far it has done pretty well. Now we generally end up making conclusions based on the recent experience. So when you look at last 3-4 years of performance, peer-to-peer lending looks very attractive. However, like I said, it is in a very nascent stage. It has certainly revolutionized the lending and borrowing model and offering very high returns to investors. However, it is not an alternative to FD. With high interest rates to borrowers, the biggest challenge for these peer-to-peer platforms would be to control the default rate, that is NPA. So if you are willing to take a higher risk, you can probably consider investing a small portion of your money in 12% club. But don't get carried away with high interest rates. What happens is, people start with small amount of money and when they see good interest on daily basis, they tend to get carried away and end up investing a large chunk of their money in peer-to-peer lending apps. So that exposes them to higher default risk. So if you can manage your risk and take a judicious call, then you can consider investing some money in 12% club. But this is not a promotion of 12% club. I've tried to be very transparent and honest with my analysis and opinion. By the way, let me also mention that the interest earned on these peer-to-peer platforms are taxable as per your income tax slab similar to FD. So this is it for this video. I hope you got a good picture of what exactly is the business model of peer-to-peer lending companies, the key difference between FD and peer-to-peer lending, the risk versus reward, what exactly is this 12% club and how it works, and if you should invest in 12% club or not. If you find this video useful, do share it with your friends. And if you have any query, let me know in the comments. I'll see you next video. Till then, take care.